And it is Saturday, and we're going to be talking about money. We've got a very, very important program today. We've got a guest who really understands that opinions are very different from facts. You want to hear what he has to say and what his company does. We also want to focus. It's the beginning of 2024, and we want to talk about where are we headed in 2020. In 2022 and 2023, over 90% of the economists, almost every CEO, and all of Wall Street said we were going to have a recession. It was only a question of, is it going to be a deep recession or a shallow recession? They were wrong. If you were listening to our program through 2022 and 2023, you know what we were saying. We were saying with 4 million more jobs than there are workers to fill them, the chances are there's not going to be a recession. But we were like a pebble dropped in the ocean. You know, the ocean was Wall Street and economists and CEOs. They all thought it was a recession. Didn't happen. So where are we in 2024 and where we're headed? We think it's going to be very different again from what you hear the economists saying, from what you hear CEO saying, from what you hear Wall Street saying. We think there's some things you should be concerned about. Very, very different from what you'll hear other places. Will we be the pebble in the ocean again? Probably. But, we think there's a way to make that work for investments. We don't think we're going to be as caught off guard as we were during 2022 and 2023. So we're going to let you decide what you think after you hear this program. But before we begin, we want to talk about China, because the beginning of 2023, almost everyone was saying you need to sell U.S. stocks. They're going to go down. We're going to have this recession. U.S. stocks are going to go down. You need to buy bonds because they're safe and those prices are only going to rise. And you should buy Chinese stocks because China has opened up after COVID and there's huge value in China. That's what they said at the beginning of 2023. They were dead wrong. They were dead wrong about U.S. stocks. U.S. stocks had a good year. They were dead wrong about bonds because bonds sank. They didn't rise. And they were dead wrong about China. And we're going to talk about China 2024 because now they're saying last year may have been special about China, but this year, we don't think so. So, Al, tell us more about China.
So, Mike, if you look at the BYD is a electric vehicle maker. They just passed Tesla as the world's largest electric vehicle maker. Yep. If you look at the value of the company, it's a pittance compared to a Tesla. If you look at Alibaba, another really good, well-run company, it has a, think about this, Amazon, it's the equivalent of Amazon over in China. Amazon doesn't have nearly the market share that Alibaba. Alibaba has a 50% market, yet their stock valuation is only $179 billion, where Amazon is $1.5 trillion.
Well, you can say maybe that makes it a really good buy.
You could say that, and a lot of people have said that. A lot of people have said that these companies are really good buy. Look at the valuations they're trading at. One's trading at, I think, 9 times earnings, where Alibaba's trading about 9 times earnings, where Amazon's trading at about 75. They say, oh, that's a really good buy. We should be buying stock. But the problem is where those companies are based. Being based in China doesn't provide a lot of value. It provides too much geopolitical risk for investors to want to go over there. Nobody wants to go over there. And we've seen stories of companies that have opened up shop over there, and their workers and their business leaders over there are being arrested because they violated a Chinese data protocol, or they think they're spy. They're being arrested. Their assets are being seized. So nobody wants to set up shop there. And what they're over there and doing is they're basically they're gonna go over there, set up shop, and borrow the money from Chinese banks and realize, well, if we get it seized, they're only taking their own money back, so we don't care. And this is what's going on in China. And furthermore, they have a 21% unemployment of young people in their 20s. 21, they have a real estate problems that are like 2008, maybe even worse. We really don't know because they don't allow to know the intricacies of their economy there. Not just their economy, but what goes on in their country. Take, for instance, Mike, a story I read about their crime rate. They said that 50% of all murders in Shanghai and Shenzhen province were done by strangers. 50%. 50%. Now, I'm no criminologist, but we all know from watching enough Datelines in 48 Hours that it's always, who's the first person when the wife or the husband gets killed?
The stranger.
Yeah, the stranger, right. They go wandering the streets looking for people that look like they might have committed the crime. We all know it's a husband or wife. That's what, so their statistics don't make any sense, and it goes on with their economy too. Things that they do. So I go back to their real estate problem. So they went and they borrowed all this money, these real estate companies, to build real estate, and then they have tracts of real estate over there that are unfinished that people have put down payments to pay for a pot home, unfinished. So they foreclosed on them. I'm not foreclosed, excuse me. They defaulted on their loan, saying, why should I pay for an apartment that I can't live in? Well, that makes a lot of sense.
And those same people will go to the grocery store and they've been blackballed.
They've been that's what the government does.
So they can't even buy groceries or clothes?
That's right. They blacklist you, so now you can't travel, you can't get on a plane, you can't use your debit, can't use your credit card. And so these are much more systemic problems and structural problems, I think, to their economy that they have. And they're way more problematic than what's going on with BYD, Alibaba, and their real estate. Those can somewhat be fixed, but and I think it kind of starts with their prime minister, Xi. I mean, he basically tells us people who are suffering, who can't find jobs, to eat bitterness. That's his words, eat bitterness.
That really adds a lot of calories.
Well, I think psychologically, economically, and philosophically, where they're so different than the West, is that it's having. I think it's kind of a dramatic. We would also talk about their aging population. They have an elderly population in the whole United States that they're not dealing. They're going to have a hard time dealing with. I don't know how they're dealing with it, but they're going to have it dealing. And another thing philosophically is like their one-child policy for so long was a disaster because now they can't get people to have babies. Their fertility rate is way below the replacement. That's a huge problem. And their next door neighbor, India, still has a relatively high fertility rate that's dropping, but they have a young population. They're of working age people. So I don't think China's going to be out of the woods in 2024. I think they're going to get a lot of issues to go through. We don't even know most of them because it's really hard to find out what goes on.
And I think the way that they're treating a lot of businesses, especially the internet businesses, is they want a politician on the board of directors. They want board of directors to be 3 people. One of those is appointed by the government. And they want to move from the cultural centers into the countryside. I think all those things have a negative impact. What does a politician, ByteDance, the person that came onto the board of ByteDance, was in charge of propaganda?
Well, yeah, I mean, but these are more long-lasting problems. Really, write down some debt, move a company, finish those projects. I think this generational time that they don't really get out of because they industrialized so fast and they built roads, airports, and infrastructure, which they did a great job of doing. I haven't been there, but people who tell me who've been there said it's beautiful, really, really nice. But you can only build so many roads and so the only way to get the economy to the level to have a consumer economy where you have some freedom and buy stuff, but they're not willing to do that. So they might be stuck in what we've discussed before is this middle income trap where a country just stays stuck at this income level and can't break through that ceiling to actually get to where they want to get to it being advanced.
And I think there's, the speed at which they grew, mercantilism, and we've talked about that before on this program.
Yeah.
The model that they had from France from the 1600s, we've talked about that. I think most people didn't understand what was happening during that period of time.
No.
And it just...
they were blinded by greed, Mike. Come on, these companies went over there and saw, 1.4 billion people, this is a gold rush. And then after they got screwed a couple times and realized, wait, was they just taking apart our equipment and building it for themselves, they got tired of being ripped off and said, the heck with this, we're not going to do this anymore.
Yeah.
And I think that's what's happening. And then with the chip industry, where we finally said, hey, wait a second, they're taking the highest and best technology, not using it for good, using it for weapons and using it against their own people and using it against us. Why should we supply them with the best technology in the world? No, we're not going to do it anymore.
They're really good at copying.
Yes, and for them to catch up to us in that chip, for those nano chips that we're building that are getting smaller and smaller and more powerful, it takes like 30 years to build those plants. Technology going, they're way behind. They're generations behind us.
And it's going to take time for them to catch up. That really involved and really puts the spotlight on really. Is China a good investment? I don't think so.
I think it goes to something. As I said, their ideology. We talked about it before that America's kind of like the jungle, and it's our economy and democracy. It's messed, not clean and smooth, and they want everything in nice, tight, neat rows, right?
Yeah.
And I read this piece out of this book. It was written in 19. We'll come out to a commercial. We will wrap this up when we get back. And
stay with us. We'll be right back.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, we were wrapping up on China, and something interesting I read. I read this excerpt from this book. You'll love this title, written in 1939. Abraham Fleck, The Usefulness of Useless Knowledge. And
I think I have a lot of that.
he goes on to explain how things became, like the radio we're on. He talks about the guys before him, Hertz, that developed these pieces that didn't know how to all put it together. And it was Marconi, the Italian, who actually put it together. But so it starts out with a conversation he's having with Eastman of Eastman Kodak. And he says, who's the greatest scientist out there? And he's, well, easy. It's Marconi created the radio. And the guy says, no, it was Hertz and his partner. I can't think of his partner's name. Because they actually created all these little pieces that went together just by two guys tinkering that developed these.
I think those guys that wanted to go to a big trade show, and they were the ones that figured out how to put a radio in a car, and they were barred from the trade show. They said that's not something we should have at the trade show.
Oh, I haven't heard that.
So they set up in the parking lot in front of this place and had the radio blaring, and it caught everybody's attention. They sold a ton of radios, and they named their company, of course, because it was for the car, Motorola. That's how. Anyway, okay. Sorry about that.
No, that's okay. But I'm just relating a point to China that, America and the West is more like we tinker, and we know things aren't going to be always neat and clean, that we're just willing to tinker and make things and see what happens from. Where I think right now in China's philosophy is that they want everything in neat rows and everything just to come out perfect, and it just doesn't happen that way.
Oh, and I think the Motorola example is probably perfect, because had that happened in China, they would have been arrested for not having a permit to be in the parking lot and do a demonstration.
Exactly.
They would have been locked up in jail.
They would have been violating some of their communication laws or something, right? Anyway, speaking of communication, we have a guest. Let's change directions here. He is the co-founder and chief project manager of Factimize Patent Viewer. His name is Craig Kobayashi. Welcome, Craig.
Well, thank you for having me, and I'm really happy to be here today.
So tell us about your background before you tell us about how you got into being a co-founder of Factimize. About how that led.
For about 4 decades or so, I practiced as a lawyer, primarily in business as well as in intellectual property transactions. But I've always had this love of or interest in large amounts of data. So as a business lawyer, and in particular doing mergers and acquisitions, I understood the importance of going through every piece of paper to make sure that we understood what it said and how to find. And that attention to detail, especially when you're dealing with large data sets, was something that carried over to what I'm doing today at Factimize Pattern.
So tell us about Factimize Pattern. What do you do there?
Well, our target market, our initial target market for Pattern Viewer is co-parent who are in high conflict situations and they have child custody. Mm-hmm. That's what our target is. And we help parents try to understand by looking at their communication data. So that's how we do it. And we're experts in collecting and organizing data.
Is there a lot of competition? I mean, it's not a field that I'm familiar with.
We're one of the first companies in the area, and it's relatively new because the way that communication data has evolved, all of this stuff is less than 20 years old today because if you'll remember, there are no such things as emails until about 1995 to 2000.
Yeah.
There's no such thing as text messaging until T-Mobile came out with its Sidekick and people started picking up on what a text message was. And there were no things like third-party diary services for co-parents today because people just didn't understand what was going on. And since then, there's been an explosion of these kinds of communication data that's out there that's really hard for professionals.
I know, but I just was listening to something the other day where they talked about people reading their personal journals and journals online, and people, they got like millions of followers to listen to their journals online, and they get and make a huge amount of money reading that stuff online.
Who wants? I'm sorry. I'm sure there's listeners that do that.
I just thought it was interesting.
It's interesting that we have a couple of generations on this radio. Mike, of course, one of the elder statesmen. Of course, he wouldn't understand.
You can say he's just old. That's okay. He's old as dirt.
But for the rest of us who use electronic communications regularly, a lot of people do it, and they do it fast and rapidly, and they collect all sorts of information. Really hard to get. So we help our customers tell them with their.
How do people find you though? If I'm going through a divorce and a custody battle, how do I find? It seems like an obscure business that not a lot of people would really know about to use.
That's correct. Right now, we're still under the radar. We're about ready a proper product launch of all of our products and services.
Okay.
And we intend to do so by using the same kind of communication channel today, primarily social media.
Yeah.
And of course, radio.
But we spoke earlier, and you said that it's mostly not the lawyers that hire you, but the parents.
That's correct. And we're getting a lot of traction today by word of mouth.
Oh, yeah, okay.
And a lot of co-parents have picked up what we're, and they're sharing various social media.
So you'll build a website, obviously website,
Yes.
and texting, emails, and stuff like that, marketing.
Correct. But you can find us, our website today is www.facttomocracy.
Okay. And will you also market to attorneys or divorce attorneys too? Or is that potential?
Yes, it is. Two of the channels that we're looking at include the legal profession, not lawyers, but legal profession in general.
Yeah.
Because one of the problems that exists in dealing with this large, what do you do with it?
Right.
And we help to organize it and sort through it, and to be able to display it visually, use chart and develop to show patterns of behavior.
Yeah.
It's very difficult to do that unless you have the technology behind in order to that. And that's what we're trying to do. We're trying to help people understand.
So I have a question about that. So when you say you're organizing all this data and presenting it, so what do you mean you're organizing the data and making it a presentation?
Sure. One of the things that we found over the years, and we've been doing this for 15 years and looked at millions and millions of messages for thousands of our customers. One of the things that we found out is that people communicate differently using different communication channels. Sometimes people write their emails, particularly if they think someone's going to review them later on. But when it comes to other channels, text messaging, when people are just doing things almost instantaneous, then they tend to revert to a different way of communication. Sometimes those ways of communicating show the patterns of the way that they communicate that aren't necessarily positive, and sometimes are very negative. They could be abusive, they could be aggressive, and they could show some sort of anger direct. So that's why, when we do things, we take all these communication data, break them into 24-hour periods or file call, and then put them into our system so that we can look and overlay all of these different kinds of communication. The patterns are distinct or whether differ.
Yeah. It's not always going to be like Alec Baldwin a couple of years ago. Remember his rant between his wife?
And, that's one of the things that, people began to label him as a certain way. And he had to do a lot of PR in order to reverse that impression of him.
Yeah.
And then he ran into trouble again with Onset.
Well, because they had a consistent pattern of him being that way to not only to his wife, but I think his daughter. He had different conversations and just how abusive he was.
Yeah, and so what we do in Alec Baldwin isn't really a good example because we don't have a complete set of communication data on him. But what we do is take 100% of the communication data given to us, divide it into 24-hour periods, look at what communication channel that they're, and then overlay, see if they're consistent or whether they're 180 degrees different.
Right.
So in doing that and looking at a pattern, you mentioned in the beginning, you're separating opinions from fact. Explain that.
Sure. One of the things that we know is that when opinions differ, facts matter. And the way that we make facts matter is that they tell a story. Let the facts tell. We don't make any kind of diagnosis. We don't give any expert the fact. And if you explain it in a chronological way, pick graphical presentation of the data, you can see that there are trends that appear in the way that people communicate. So in order for us to be able to do that, we use a proven and repeatable methodology to be able to process the data in a consistent way so that we can rapidly organize, index, and analyze
And then you would present this to a judge or arbitrators in a
proceeding. Right, and we'll get to that. I'll
right.
answer that question
we'll get that
in just a minute.
We're coming to a commercial break. Don't go away. We want to finish this up and hear the rest of what Craig has to say. Don't go away.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So, Craig, can you give us an example of a case you worked on that, and I'm not being specific, but that you can kind of give us an illustration of?
Sure. Here's a fairly typical kind of customer that we have. A parent, in this case, the example that I will use is a mother. It has been the victim of a lot of difficult, almost aggressive and maybe even abusive behavior. And this has been continuing over a long period of There's lots of emails that go back and forth with a lot of things that include false accusations, criticisms, and blaming and anger directed by the father co-parent toward the mother. And we collect all of that data, put it together, and return it to the professionals involved, which include both the lawyers and the legal professionals involved, as well as the mental health professionals, psychologists there. Everybody has this set of data that they can then look at and interpret for themselves so that they can create both expert opinions as well as strategy when it comes to address who should gain custody. Oftentimes, in a case like the one that I'm describing, there may be false allegations.
Right.
And we're able to track that because on the one hand, you have, in this case, the father saying one thing that's putting him in the best light. But on the other hand, on the same days or within the same period of time, is saying something using text, which is completely different and shows a very different kind of, say, personality than the one through the email string. And when you give that to the professionals, they get the aha moment where they look at the graphical presentation of the data. I can use this to make my presentation to the judge or to the mediator about why custody changed from what it is today.
Because you said that those abusers tend to be really skilled at putting their best face in front of a therapist, psychologist.
That's correct. And you can see that, and sometimes, not all the time, sometimes they're very consistent.
Yeah.
In terms of the communication data and the conclusions by the experts. But sometimes an expert might misdiagnose because they've been seeing only the good side in all the interviews and all the tests that they apply. Mm. But compared to what's going on a daily basis, it may be a completely different world out there.
Right.
And what we're trying to do is just enable everyone to tell their story using their data.
That's interesting. So, you guys are a service that I'm sure a lot of people could use, and you're providing a real value to attorneys and people that are going through this that could provide a lot of clarity around what the outcomes should be.
Yes, and for what we're doing for this market, for the market of high conflict disputes in child custody, we're really driven and mission driven by the fact that this is all for the best interest of the children involved.
Right.
And that's the most important thing for us. Right. That's why we do what we do, and we do it passionately.
Right. I'm sure there's a lot of boardrooms that could use your help too. Yeah. But thank you, Craig. Thanks for coming on today. And tell everybody where they can find you in case anybody's looking for how to find Craig Kobayashi and what you do and needs your services.
Once again, you can find our website at factimize.com.
So thanks, Craig.
Thanks, Craig.
Thanks for having me.
So we want to shift now, and begin to talk about 2024 and beyond. In 2022 and 2023, over 90% of economists and CEOs and all of Wall Street were predicting a recession which never happened. They were convinced of it. They were convinced that U.S. stocks should be sold, bonds should be bought, and they built their systems all around that. At Adams Financial Concepts, if you've been listening to our program since 2022, we were saying, no, we don't see a recession. We think there's 4 million more jobs than there are workers to fill them. We think people have a lot of money in their pockets. They got stimulus checks. They were sheltering in place. They didn't have a lot of places to spend money. Sure, they got to spend it online, but they weren't going to restaurants. Maybe they went out to a restaurant and picked up a meal and brought it in, but it was not like being outside. They weren't going to movie theaters. They weren't going to baseball games or football games. They didn't have places to spend the money. And even if they wanted to buy a car, the car dealerships were shut down. So they had money in their pocket, and they had a burning desire to spend and reach out. We said 4 million more jobs than there were people to fill them. In a recession, what happens in a recession is you have unemployment happening, you have layoffs happening, you have unemployment numbers rising. We saw the unemployment falling. And so we had a very different condition than what we had in the 1960s and 1970s. But the economists and Wall Street looked back on the 1960s and 70s and said, oh, this is what happens when you have inflation. The Fed needs to raise interest rates. And the Fed, in fact, looked back and they started raising interest rates. And everyone looked back and said, when the Fed raised interest rates in 60s and 70s, it caused a recession, stagflation, in fact. And so that's what's going to happen this time. It didn't happen that time. And we've been saying it wouldn't happen that time. It's very different. But then as we move into 2024, what's going to happen there? Because inflation is still going to be a major theme of what happens in the market and what what happens with the economy. And now you don't have a real consensus, but you have more and more people drifting into the camp that the Fed has done an outstanding job and the Fed has engineered a soft landing. The economy is going well, and they've slowed down inflation. I'm not so sure that that's really true. We're not so sure that it's really true. We think the Fed raised interest rates, and that did, in fact, have an impact on inflation. We think that the soft landing is due to the fact that there were 4 million more jobs than there were workers to fill. It's not the matter that the Fed has engineered something spectacular. It's something that those were the conditions that existed. And what we also see is the inflation that started was a demand pull inflation. Now, there's economists talk about two different types of inflation, a demand pull and a cost push. Demand pull is where you have a lot more money than you have goods and services, so end up paying more than they normally would. And that raises prices, and that contributes to inflation. And when you think about what happened as we came out of COVID, you had a lot of plants that were shut down, and perhaps one of the great examples of that was the used car market. Suddenly there was a huge demand for used cars, and people had a lot of money, and they were willing to pay exorbitant prices for used cars. They had the money. There was too much money. And not only that, the federal government was doing the infrastructure deal. They were doing stimulus deals. They were doing the Build Back Better, or what they called the IRA. All of that happening. That's demand pull. More money than there was supplies and goods. The question is, and what we feel is, as the Fed has raised interest rates and as the economy has recovered, a lot of the demand pull is going away. And that's why inflation is coming down. But the conditions still exist. There's more jobs than there are workers. In 2023, the United States created 2.7 million jobs and actually had a significant number of workers that added to the workforce. Usually you add 1.5 million. We added almost 3 million workers. But that still leaves somewhere around 3 or 3.5 million more jobs than there are to fill the jobs. To get an idea of the impact, we have about 69, a little bit fewer than 69 workers in the workforce. To get to an equality of workers and jobs, we would have to reach 8% unemployment. But that's what it would take to equal. Now, there's another way to do that, and that's for automation, and we're seeing every company use automation to use and create jobs using automation rather than people. What we have right now is really a situation where the workers are in control. The workers have pressure. We've seen an enormous number of people that have quit jobs. In 2022, it was over 40 million people, or 40 million quits, and people move from one job to another job. And if you look at the surveys today, people aren't worried about losing their job because they know they can go and get another job. They're not worried about being laid off. They're more worried about what vacation they're going to take, what restaurant they're going to go to, what car they're going to buy. They're looking how to spend the money they have. And wages have been increasing as fast as the consumer pricing. If you draw the line, the two are increasing at about the same rate. So people are not falling behind on their wages. They're keeping up with inflation. They're keeping up. And what that means is we're moving from a demand pull type of inflation to a cost plus. And what we saw in the 1960s and the 1970s was a shift from demand pull to cost plus.
Plus or push?
Cost.
Push. Well, one thing, Mike, that I don't think you mentioned is one problem with the economy is housing. We're still in a housing shortage. We're seeing rents climb, and that's going to continue to be a problem in 2024. I think all the way into 2025 and potentially 2020, because you can't build houses that fast.
That goes back to the Great Recession when we quit building houses. Yeah. And we're still trying to catch up.
Mm-hmm. So that's a problem. We're seeing rents, just even around here in Seattle, rents going to continue to rise.
Mm-hmm. But that's still on the demand pull side. We're coming to commercial break. Don't go away. We got more to say about this. What is happening for a cost push inflation, and where does it take us in 24 and beyond?
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Looking back into the 1960s and 70s, in that great period of inflation, in the 1960s, we had a demand pull inflation that was taking place. You had the Great Society, you had Medicare that were coming online, all of the civil rights movement, all that spending. You suddenly had a lot more money pouring into the economy than you had goods and supplies. You had the Vietnam War, and that also poured a ton of money into the economy. But as we shifted, inflation was coming down in the late 60s and early 70s. We were actually entering into a recession because the Fed had raised interest rates, and they were at the point that they were almost ready to pull down rates. In fact, Arthur Burns did do that when he became chairman of the Federal Reserve. But in 1972, the inflation switched from a demand pull to a cost push. When OPEC came up and decided to do an oil embargo, suddenly you had oil prices skyrocketing. And with oil prices, that was a cost push up. That was something that Volcker began to raise interest rates and began to push the economy further into recession. So we had inflation and a recession, stagflation taking place in the 70s as they pushed interest rates up to slow that down. But you also had a lot of other things going on. You had a big push to do conservation. You had a push to change technology, to lower the amount of oil consumption. We reached a per capita oil consumption in 1972, which is the highest we've ever had in India and worldwide. So that was the focus on how they took care of the cost push inflation, and wages kind of followed up as well. This time, it's wages that are probably going to push inflation up. And if you look at cost push, the cost push is about 2/3 forced by wages and 1/3 by material. 1/3 by oil, and oil will not be a factor in the next push, but wages are twice the impact as materials. And as we have wage pushing up inflation, that's probably going to start happening by the end of 2024. Now, what we saw in 2022 and 2023 was the Federal Reserve and the economist and Wall Street looking at what happened in the 60s and 70s and saying, okay, we're going to push up interest rates and that's going to send us into a recession. Our guess is that as we get to a cost push inflation later in 2024 or as we go into 2025, people are going to look to the Fed and say the Fed engineered a very soft landing. They can do it again in the same way. And what's going to happen is as the Fed raises interest rates, it's only going to push wages higher. It could exacerbate the whole situation until the Fed actually reverses the trend of job creation again to get job creation. That process is going to take years to change. So, it's not a very pretty picture looking forward. And yet there are lessons from the 60s and 70s for people who did very well, not by buying index funds. There weren't index funds, but if you bought index funds, you wouldn't have done very well. It took 32 years for the Standard & Poor's to catch up with the consumer price index in 1966 to 1992. From 1982? No, 1968 maybe. From 68 to 90, it was 32 years to, so 61 to 93. If you look at the consumer price index in 1961 and where it stood, and it increased sixfold during that period of time from 63. The Standard & Poor's from 1960 took until 1993 what the consumer price index. But in the meantime, if you look at what happened to some of the companies, there was a little company that sold 19-cent hamburgers. Who would have thought that would have changed our habits? McDonald's came public in 1966 and grew over tenfold during the 66-80. There was a little company that was a radio repair shop in Colorado that grew 20 during that period of time as they understood that the transistor was going to die. There were some companies that focused on random access memory, advanced micro devices, that grew 170-fold during that period. So there were companies that did well in spite of what happened, that cost push inflation. We think there's going to be reason to be focused, being in the right place, right time as you go forward. Or, we lay it all out there. It's probably we're probably some of the very few, maybe the only one, that will talk about inflation coming down during 2024 to bottom out and then to begin to rise. That may not happen, but we think there's a significant probability. Back in 2016, we said, how will this bull market end? How will this whole thing slow down? 2016, we said, inflation is the highest probability. Here, 2020, we didn't see a pandemic in the meantime, but we saw out of the underpinnings of inflation coming. You could see it as early as 2016. See job creation happening. You could see the government spending money. You could see the dollars coming out, and the pandemic only accelerated it. Happened. That's not a pretty picture. Average investor.
So what does that mean, Mike, for the stock market in 2024? Are we going to see sideways, go down? What do you think?
I think for most of 2024, we're going to see a marvelous stock market because the Fed is lowering interest rates. And there's going to be huge political pressure by the administration because it's a presidential year.
It is.
To keep the interest rates down.
I don't know. I thought I was optimistic at the end of the year, but I'm turning a little bit more pessimistic this year just because I think a lot of people watching all the geopolitical stuff, what's going on in the Red Sea, and then waiting for this election to happen, are going to sit on the sidelines and wait to see who becomes president and what's going to go on. I just think that there's a little bit more pessimism out there than we're alluding to because we rode a wall of worry in 2023. Because everybody thought it was going to be such a bad year, and it turned out to be a great year, right?
Yep, and we're going to have a worse year in 2024 with worry.
Yeah.
And the first week of the year was down?
And the first month is not looking good. That's not a good omen, Mike. According to the Stock Pickers Almanac, if the first 5 days are down and the month of January is down, that's
it has not always been
as
true.
my old Sicilian boss would say, things that don't look too good.
They don't look too good.
So I don't know. I'm a little bit more pessimistic than I was in the fall.
And the computers are reading all that data, and the computers are acting like
they're predicting. But let me clarify, though, because long term I'm optimistic. I mean, 2025, 26 on those years, I'm optimistic long term. But this year, I don't know, and I'm not as optimistic as I was.
I'm optimistic for 24, and I'm not very optimistic for 25 and 26.
Well, we can argue and we can disagree over that. We can pull some data in here and argue on the radio. So maybe not. Craig doesn't want to listen to us, but maybe, I don't know.
In either case, we know that we want to be invested in the right time.
Yeah, we definitely stay invested. I'm not saying get out of it. Don't put your money in China, by the way, anyways.
That wraps us up for this week. Have a great week, and we'll be back talk about things next Saturday. Talk about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.